So in chapter 2, we learned that under the job order costing system, how to track the three types of manufacture costs and determine the total cost and unit cost of the jobs. Most importantly, we introduced how to use the predetermined overhead approach to allocate the overhead, which is the indirect manufacture cost, to the different jobs. This is a very critical part of the costing system. In chapter 3, we'll continue work on the job order costing system, but focus on reflecting and tracking the cost flow in the financial accounting system, such as making journal entries for the transactions incurred and prepare different cost reports. In this video, I will demo the cost flow example used in the book, so chapter 2 on page 15. In the book, they present the cost flow of among different accounts in different places, but I made a Excel worksheet. So I'm putting all of the transactions together and all of the financial accounts together. So in one single place, you can see how the cost flow among the different accounts and very clearly, and how the recording of these accounts and the balances will help us to prepare the different financial statements and cost reports. So let's start from the left side. As we learned from chapter 2 and as you read along the book, the manufacture process starting with purchasing raw materials. That's right. Before you can use the materials in production and any other purpose, we have to purchase the material and then use it for different purpose. So for the raw material account, because this is a current asset inventory, we normally have some beginning balances. You couldn't really, I use all of the materials we bought. So we have some beginning balances on the debit side, so 7,000. And then the company bought another 60,000 material. Later you can see probably you using cash or on account. So we debit the raw material 60,000 and credit cash or credit accounts payable if you purchase the material on account. So the credit side can be use different accounts depending on the payment approach. So purchase raw materials, you add the material on the debit side. Then we apply the materials to the production and other purpose, we reduce the material from the credit side. So for asset account, we reduce from credit. In our case, we used 50,000 raw material for the working in process, which is the direct material. Direct material will be used for production directly. Then you can also use material for manufacture overhead, such as repairing machineries or for other consumption purpose. So for that part used for manufacture overhead, we call indirect materials. So they will flow, the direct material and the indirect material will flow to different accounts. The direct material we add to the working process, which is another inventory account. We don't have working in process inventory in 231, so this is an account for manufacturer companies only. For direct material, we debit the working in process, like you can specify the job name and credit the raw material. For indirect material, we debit the manufacturer overhead. We have a separate account for manufacture overhead, which includes all of the indirect manufacture cost. So debit the manufacture overhead and credit the raw material. Okay, so different purpose. And then the labors. We have direct labor and indirect labor for the manufacture process. For direct labor, we put it into, let me see, 60,000. Oh, I see. So for the labors, the direct labor is 60,000 and indirect labor is 15,000, such as the wage and benefits of the factory supervisors. So this 75,000, like credit wage payable, we debit the working process for the direct labor and debit the manufacture overhead for the indirect labor. Okay, so total manufacture labor is 75,000, including both the direct labor and indirect labor. And this 30,000 wage payable used is related to number 8, is the period cost. So all of the wage and salaries belonging to the selling, admin, and general expenses. So period expense, they are not included in the manufacture cost. But on the credit, we all use the wage payables because when the payroll make the payroll worksheet, it include all of the personnel in the company, but depending on their position and functions, the debit will differentiate the staffing, their positions. So direct labor in the working process, indirect labor in the manufacture overhead, and all period cost labors, like not really labors, salary and wage, we put it in the related period expense account. So that's the labor cost. Then the manufacture overhead. So now let's focus on the applied manufacture overhead. We explain the reason using the applied overhead in chapter 2. For our example here, the applied overhead is $90,000, and this 90,000 is based upon 15,000 total direct labor hours. This is the actual allocation base. And we have a $6 predetermined overhead rate. If you check the book, they have explanation of how they come up with the $6 and the 15,000 direct labor hours. So the applied overhead $90,000, we debit the working process and credit the manufacture overhead. Be careful at this point of time. I'm skipping the actual overhead. In the next video, we'll pick up the manufacture overhead, the difference between actual and applied overhead, and how to allocate the difference for the manufacture overhead. In this video, let's focus on the main cost flow. So the applied overhead is 90,000. And also, under the job order costing, we have two jobs because the working process, this is the general ledger. So all of the total cost for the two jobs. Underneath, we have subsidiary account for job A and job B. When making journal entries, we can separate, how much materials for job A and job B, and then in your ledger account, we have sub-ledgers for the two jobs, or if you have more than two jobs, you can open more sub-ledger accounts. But when you make journal entries and in the book, we focus on the main cost flow, and you can see the beginning balance of the working in process is for job A because you started job A from prior period. So we have a $30,000 working process beginning balance. For job B, we started on this in this month. There is no beginning balance, is only new manufacture cost. So that's the case. Okay, so we can see the sub-ledger account for the total manufacture cost. In the end of the period, so given by the book, the job A is completed. Be careful, only job A is completed. So the total cost incurred for job A is transferred from the working in process account to the next inventory account, which is the finished goods. Make sense? So once the job or products are completed, their cost wouldn't stay in the working process, and they have to be removed to the next stage of the cost flow, which is the finished goods. And this transferred cost we call cost of goods manufactured. So if you started on chapter 3, you probably noticed that this important concept in chapter 3, or cost of goods manufactured. So that's referring to the cost of the job or products which are completed from the working in process inventory. And then we have the ending balance under the working in process that's reflecting the accumulated cost for the job B, or like the job we started but incomplete by the end of the reporting period. So 72,000 in our case. And then continue looking for the flow. So after the finished goods, and assume among this 158,000, we sold some, most of them, okay, not all of them, but most of them by the amount of 118,500. And the finished and sold units, their cost is labeled as cost of goods sold, and this is the same account we put in the income statement. So now after you trace the cost flow, you understand where the cost of goods sold in the income statement come from, or is transferred, is flow all the way from the material, labor, overhead, through the working process, and then through the finished good, and then finally we put on the income statement. So now back to the finished goods. For the unsold units, or if completed but unsold units, they stay in the finished goods warehouse, and their cost is still under the finished good inventory. So when we finish the period, we'll have 3 inventory account balances. 3 inventory accounts for manufacturing industries. You normally has raw material balances, working in process balance for the incomplete jobs or products, and then the finished goods inventory for the unsold units. They are all inventory, but they represent different types of inventory. So you can pull all of their balance together. That will be your total ending inventory. But normally you can see they put the total inventory in the balance sheet. If you want to know the details for the inventory, you can get the information in the notes part of the financial statements. Or if they didn't put the 3 types of inventory on in the balance sheet directly, you should be able to see those information in the notes for the inventory information. And in the income statement, you see the product cost or manufacture cost, and this is labeled as the cost of goods sold. After the cost of goods sold, you also can see all of the period expense or period cost, including the total selling expense, admin expenses, and other general expenses. Those are period cost. So you see those items didn't go through the cost flow at all. We directly add all of the expenses, period expenses together, and deduct them in the income statement after the gross profit. Okay, like here. So this is um, how we report the income statement based upon the ledger accounts. So I like this Excel. The advantage is rather than you see the accounts and information in pieces and in different places, we put everything together. So it's really like the flow, like a flow charts. Clearly you see with the arrows, so we can see all of the flow of the cost information under different accounts and how the balances will help us to prepare all of the statements. So I will stop here for this video. In the next video, let's dig more on the manufacturer overhead and how to determine the under-applied or over-applied overhead balance and how to dispose them to the income statement and how to close the manufacturer overhead.